Hello and welcome back to another weekend roundup with me, Shrestha Tiwari. You're watching Companynama and it's time to give you all of this week's corporate and startup highlights. First up to the corporate world. Global investment management firm Bernstein has pegged the enterprise valuation of Reliance Industries' 85% stake in Reliance Retail at $111 billion while valuing the Mukesh Ambani-led company's 66.5% stake in telecom and digital platform arm Reliance Jio at $88 billion. Reliance Industries had earlier planned to list both its subsidiaries to unlock value for its shareholders but did not fix any timeline for it. In more news on Reliance, the group's online wholesale format JioMart has reportedly laid off over 1,000 employees. This comes after the company aims to align its operations with Metro Cash and Carry that it acquired recently. According to media reports, this round of layoffs is part of a larger round that would reduce its 15,000 strong workforce in the wholesale division by 2/3. The group is also rolling out a cost efficiency drive across its units, Reliance Retail and Reliance Jio Infocom, reducing hiring, reviewing compensation benchmarks and firing underperformers, multiple executives from the company and the wider industry, according to media reports. Vedanta, owned by Anil Agarwal, has pledged almost all of its holdings in Hindustan Zinc as collateral for loans. The company created a pledge on 13.94 crore shares on or 3.3% of the total equity. According to BSE data, the total encumbered equity share capital stands at 64.51% from 64.92% earlier. The shares were pledged on May 23rd. Vedanta also announced its first interim dividend of 18.50 rupees for financial year 2023-24. The dividend will be 1,850% of the face value of 1 rupee per share and amounts to a total of 6,877 crore rupees. And in a bid to tackle its soaring debt burden, Vedanta Group has also raised an $850 million fund with JP Morgan and Oaktree. The conglomerate raised this amount after signing a 5-year loan for about $850 million. The transaction takes place just before Vedanta Resources must pay back a $500 million bond. Earlier, the company had tried to sell its zinc assets to Hindustan Zinc for $3 billion, but it failed to do so. JSW Group has joined the race to acquire 2 coking coal mines from Australia's BHP Group in a potential $1.5 to $2 billion deal as the Indian steelmaker looks for resources to fire its blast furnaces. The Daunia and Furnace mines with 20 million tons per annum capacity in Queensland are being sold by BHP following a 32% drop in half-year profit, dissatisfaction with the state's coal royalty hike, and along with ESG, that is environmental social governance concerns. JSW at its current capacity needs 18 million ton of coking coal per annum. To achieve 25% of integration, the company requires about 4.5 million ton of captive coking coal, but that kind of supply is not available in India, and hence the hunt for global assets. Further, JSW Steel, which recently announced a fresh plan for raising 18,000 crore rupees, will use the entire proceeds to refinance its upcoming debt maturities of around 14,000 crore rupees in FY24. The government is planning to merge Mangalore Refinery and Petrochemicals with Hindustan Petroleum Corporation. The decision came after ONGC acquired HPCL 5 years ago, and the move will help ONGC to streamline its downstream vertical. After the acquisition of HPCL by ONGC, there were plans for the merger of HPCL and MRPL. However, it took 5 years for the ministry to start the execution of the plan. Now, the ministry is working on the HPCL and MRPL merger, which will mainly be a share swap deal, according to media reports. Wipro Executive Chairman Rishad Premji's compensation almost halved in the financial year 2022-23 from the previous year due to negative performance in its IT services businesses. Chief Executive Thierry Delaporte's compensation also fell, but by a smaller margin of 5%, according to the company's annual report to the US Securities and Exchange Commission. Premji's total compensation for FY23 was $951,000, down from $1.8 million in FY22. But this is not the first time that Premji has cut his compensation. In FY22, his compensation was cut by almost 31% after the onset of COVID-19 hit Wipro's operations. Delaporte, who is also the company's managing director, received $10 million compared with $10.5 million in FY22. Delaport was the highest paid CEO in the Indian IT sector in FY22. Meanwhile, Wipro reported a net profit of 3,074 crore rupees for FY23, down 0.4% year-on-year, with the company's senior management taking cuts too. Moving on from corporate headlines to those corporate giants that were on the radar this week, let's take a look. First up, Zee Entertainment stock jumped up to 8% on Friday as the NCLAT stayed the NCLT's May 11th decision. NCLT has asked BSE and NSE to reassess the initial approvals given for Zee and Sony merger. On May 11th, NCLT had also issued a directive to the exchanges to re-evaluate and validate the non-compete clause related to this merger, which was challenged by Zee Entertainment in NCLAT. The Mumbai bench of the NCLT has ordered the BSE and NSE to reconsider their initial approvals for the merger and issue updated no objection certificates before the next hearing. The development puts up fresh hurdles to the long-awaited merger of the two broadcast companies, according to media reports. The case will be now heard by a division bench on June 16th, the report has added, and the NCLT had on May 11th directed the exchanges to reassess and validate the non-compete clause, which was again approved by the exchanges and the market regulator SEBI as per reports. Earlier this month, SEBI had issued an adverse interim ruling against the entity of the SL Group that founded Zee, which led to the NCLT directive. Aviation regulator DGCA on Thursday granted 30 days to cash-strapped airline Go First in order to submit a comprehensive plan for the revival of its operations. The airline had clarified on Tuesday that they have no definite timeline for the resumption of operations. Go First has been asked to furnish the status of availability of the operational aircraft fleet, pilots and other personnel, maintenance arrangements, funding and working capital and arrangements with lessors and vendors, among other details. The revival plan, once submitted by Go First, would be reviewed by the watchdog for further appropriate action. Earlier, DGCA had said that it would conduct an audit of Go First before allowing the flight. Meanwhile, DGCA on Wednesday told the Delhi High Court that it has not rejected but kept in abeyance its decision on aircraft lessor Pembroke Aircraft Leasing's application for deregistering its aircraft leased to Go First. Also, NCLAT on Wednesday directed 3 more aircraft lessors of Go First to approach NCLT for repossession of aircraft which have been leased to Go First. The Adani Group is exploring the possibility of monetizing parts of its real estate holdings that have internally flagged as non-core to its operations. As per reports, the group has already identified some such assets and is in the process of adding more to the list. These will be sold based on the need for funds to invest in the new real estate projects that it is taking up. And in more news, the Registrar of Companies in Gujarat, in a ruling earlier this month, had held that Adani Power and its officials had violated provisions of Companies Act 2013 by not reporting related party contracts and transactions in the Register of Contract. The adjudicating officer imposed a penalty of 75,000 rupees each on Gautam Adani, Chairman and Director Adani Power, Rajesh Shantilal Adani, Managing Director, and Vineet S. Jain, Whole-Time Director. Further, investment firm GQG Partners is in talks for an additional investment of around $1 billion in Adani Group shares, having reaped bumper returns on the close to $2 billion it flowed into the conglomerate's stocks in March. The investment, if it goes through, will be part of Adani Group's effort to raise funds from stake sales in 3 companies: Adani Enterprises, Adani Green Energy and Adani Transmission. Shares of LIC saw a jump of up to 4.4% in the opening trade on Thursday. The reason behind this jump is the bumper profit of the company in the 4th quarter of FY23. In quarter 4, the company has registered a profit of 13,427.8 crore rupees, which is 466%. That is 5.7 times more than the same quarter last year. The company's net premium income fell 8.4% to 1.31 lakh crore rupees from 1.43 lakh crore rupees. The company's profit has decreased by 10% from 40,431 crore rupees to 36,397 crore rupees in the entire financial year, which includes 27,240 crore rupees of solvency margin money. Now, what did the investors of LIC get? Despite bumper profits, the company has declared a dividend of only 3 rupees per share, while investors are facing a loss of 36% on their investment as against the issue price of 949 rupees. Apart from this, there is also news that till Wednesday evening, May 24th, the value of LIC's investment in 7 companies of Adani Group increased to 44,664 crore rupees, which is 54% more than the recent low of 28,988 crore rupees. Well, that was all about corporate world. Moving on to this week's big updates from the startup world. Let's find out. Ola Electric, India's largest electric two-wheeler company, is reportedly planning to raise between $800 million and $1 billion, or 6,560 to 8,200 crore rupees, through its initial public offering, primarily to fund its capital expenditure. The company is looking at a valuation of $10 billion or 82,000 crore rupees. The IPO is slated to hit the bourses in the last quarter of the current fiscal year. It would make Ola Electric the first Indian EV company to be listed. The Bengaluru headquartered company has roped in Goldman Sachs, ICICI Securities, Axis Capital and also Kotak Securities as the lead managers for its IPO. The electric scooter maker has secured $300 million in its latest funding round, in another news which will push up its valuation to $6 billion. The company had raised $200 million at a valuation of $5 billion in January 2022, and the latest round is being led by a leading sovereign fund company and has received an overwhelming response from other investors as per reports. Walmart-owned Phonepe has secured an additional $100 million investment from General Atlantic, a leading global growth equity firm, at a pre-money valuation of $12 billion. This new funding is part of Phonepe's ongoing fundraise of up to $1 billion in capital following its domicile shift to India last year. With this tranche, the company has raised a total of $850 million from several global investors. This includes a total of $550 million from General Atlantic alone. This February, the Bengaluru-based unicorn raised $350 million from General Atlantic at a pre-money valuation of $12 billion, making it India's most valued fintech player. Other investors that backed Phonepe include Qatar Investment Authority, Microsoft, Tiger Global and a few small hedge funds. And in a notification issued late on Wednesday, the government identified 21 countries' investments from which will be exempted from the recent change in tax rules, bringing investments from overseas jurisdiction under the angel tax. The government has notified the list of specified jurisdictions featuring 21 nations, including the US, the UK, Australia and Germany, which will be eligible for immunity from the new tax. In a surprise move, the tax department has excluded Singapore, Mauritius, Netherlands and Luxembourg from the list of the countries exempted from the stricter angel tax rules implemented recently. And these are countries that are the biggest contributors for foreign direct investments in India. This means that any investments from these excluded countries will attract angel tax. According to the new announcement of the government, such Indian startups which are not listed in the stock market will not be charged angel tax on non-resident investment. Let us also tell you that the government had made a provision to tax this investment in this year's budget. Angel tax was introduced in 2012 with the aim of preventing money laundering, and if startups raise money from angel investors and this funding is more than the fair value of the shares, then it can be taxed. Angel investor refers to those high net worth people, that is investors who invest their personal income in the early stages of startups or small and medium companies. In return for this investment is what they get, equity in the company. With that, it's a wrap on Companynama this week. See you again next Saturday, and for your daily corporate updates, watch Corporate Central, Money9's daily show on corporate and market, and also log into www.money9.com to Money9's website in an all-new avatar to get a detailed insight from the personal finance world. Have a safe weekend.